Welcome to Stocks in Translation, Yahoo Finance's video podcast that cuts through the market mayhem, the noisy numbers, and the hyperbole to give you the information you need to make the right trade for your portfolio. I'm Blikre, your host, and with me is Yahoo Finance's head of news, Myles Udland, who's here to keep us honest and connect Wall Street with Main Street. Markets are hovering close to records, AI leaders, they look pricey, and investors are trying to decide whether we're in a healthy re-rating or the early stages of a bubble. Our guest today runs income and stock ETFs and will tell us where he sees investment opportunities across stocks, bonds, and housing. Our phrase of the day, market bubble. Are we in one? Is one on the horizon? We tackle these critical questions for investors. And on Market Show and Tell, we tackle a simple technical analysis indicator that's been generating a lot of headlines recently, the moving average. And this episode is brought to you by the number 2%. That is the Fed's inflation target, which the Fed has been tripping over for 4 years. Meanwhile, Jay Powell and co. are in rate-cutting mode. Is this sustainable? And today we are welcoming back Jay Hatfield, who is the founder and CEO of Infrastructure Capital Advisors. He's also the chief investment officer of the ICAP family of ETFs, where he runs income-focused strategies across the capital stack. With nearly 3 decades in the markets, he's previously managed portfolios for Steve Cohen's SAC Capital. He also runs a charity, Tutoring America, that supports low-income students in the U.S. and in Ethiopia, Jamaica, and Haiti. So, Jay, great to see you here again. It's been a while since we last talked. What do you think of the markets right now?
Thanks, Jared and Myles. It's great to be back. Well, we're a little bit non-consensus in that we're still bullish, but we do like numbers instead of just opinions. So
yes, we
have a 7,000 target. And what a lot of people forget is targets are meant for selling as well as buying.
So did you sell?
We trimmed a little bit when we got to 69.40, so that's a full valuation. That's 23 times.
In the S&P 500.
In the S&P 500, which is what most market participants use because it's more liquid than Dow. Of course, it uses NASDAQ too. But we also have a 7,900 target for the end of next year. Same thing, 23 times 27 earnings. So that argues for not selling too much. If you're a super fast trader, you can try to take a little bit off and add it back. But we think the market's stabilizing. You mentioned the moving averages were below the 50, but above the 100. So we remain constructed. And I actually think, as you implied, that it's good that the really, to use a technical term, really stupid things are getting annihilated. So like Bitcoin treasury stocks are ridiculous in our opinion.
We're going to have some people writing letters here. Yes.
In other words, those made sense before you had ETFs that you could hold Bitcoin with. Now that's just an expensive, usually sometimes overvalued way. If they're trading at a discount, then that's okay. Mm-hmm. So, but that's puts some market discipline. People actually have to do valuation and think about these things versus just looking at a chart and just going up and buying it.
It's interesting, Jay, you talked about being non-consensus by being constructive in this environment. We're only like, 3 or 4% off the record high in the S&P. Does it feel like it's a particular disconnect right now to you between the price action we're seeing, how far we've come in a lot of these key names, and how, I don't know, just kind of down everybody feels about the market? The conversation seems like it would be down 15% on the S&P, and we're really not that far from record highs.
Well, what happens, the way I like to talk about it is we have, of course, fear and greed in the market. And so during earnings season, I said this 1,000 times, but everybody seems to not focus on it. Greed is dominant. And after earnings season ends, in this case, it was really tech earnings season. So it was about a week and a half ago. And I told our research team, like, be careful now. Mm-hmm. And so then fears predominate. So every short seller comes out and says, oh, AI returns are terrible and the world's coming to an end and there's cockroaches and raid's not going to work on the cockroaches. And everybody kind of piles on that.
Yeah.
And then there's an opportunity to enter the market, and you're starting to see that. We'll see what happens with NVIDIA earnings, but that could be a catalyst for people to get back in the market.
And like related to that sentiment turnaround earnings, it feels like the last 2 weeks, we're recording this on November 19th, the conversation got really technical around like depreciation schedules and all the different balance sheets machinations. And I'm wondering from your team's perspective, if like that level of specificity is a sign, like, is that a good or bad sign? Is it a neutral sign? Does it not matter? To me, it just, I was like, that's oddly specific for something that I thought was just kind of like, hey, this is the future of technology.
Well, that sort of falls into the fear category / short sellers category. And I used to be an auditor in Silicon Valley. And it's not so much whether, so that short thesis is that the useful lives are too long. But if you have 100% return for 2 years and 0 for the next 3, you still should depreciate it over 5 years because it's a reasonable return on your invested capital. Yeah. So I think that's kind of a irrelevant point. It's also just depreciation. It's not, it's revenue.
Yeah.
So, but that's the type of thing that comes out and it gets a lot of traction because there's nobody reporting earnings. So you can say that to your blue in the face. If NVIDIA blows out their earnings, you're going to get run over if you're a short seller. So a little bit of reality today, and then now I guess this will be history when this gets actually broadcast. But so it's a relief to have real data versus speculation.
Yep. All right. We've been talking about it. So let's move on to our phrase of the day, and that is market bubble. Now, a bubble forms when the price of a stock or another asset rises far above its true value and quickly. Bubbles are often driven by hype or speculation, often end in a sharp drop or a crash. We spend a fair amount of time on this show and across Yahoo Finance asking guests if they think we're already in an AI bubble or if they see one forming. Jay, I'm sure this is something you guys talk about a lot. I'd ask it in 2 parts. 1, like, is there an AI bubble now? And 2, as you think about that concept of a bubble, are there ways that you and your team formulate it specifically to say, okay, if a market does this, then yes, this is a bubble?
Well, the easy way to test in this market, since it's so concentrated, is you look at what we call the Mag 8, so it includes Broadcom.
Sure.
And so you get 40% of the S&P. So it's a great way to actually have data. Mm-hmm. And so we have GARP models, so PEG ratio models, which are a good way to not blow up by buying things that are massively overvalued. And our PEG models show that right now, the Mag 8 are 1.5% cheap. So they're fully valued, but it's not a bubble. But I'll make one other point about bubbles. Bubbles are good. And the reason is that you get to the market the first. Mm-hmm. So it's no accident that we have the Mag 8 and everybody else in the world has the Mag 0. And that's because they don't have these super robust capital markets that we do. Capital flows where there's going to be huge returns. Many companies become overvalued, and then you end up with the smaller list of companies that crush it and end up being trillion-dollar companies. So we are going to have a bubble, but therein lies the opportunity. So the Mag 8 may be trading, like I might show up on this show next year and say, well, they're 50% overvalued. Yeah. And then you can ask the button on a bubble, and I'd say yes, but it's probably not going to end till the Fed tightens, so we might get another 50 the following year. So do you want to bail out and miss out on the party? But it becomes more risky. So it's actually encouraging that they're fairly valued now.
All right, a bubble, feature of the market, not necessarily a bug. I love that. We got to shift gears right now because it is time for Market Show and Tell, where we're breaking down a simple technical analysis concept, the moving average. It's the average price of a stock or other asset over a set number of periods or days, and it's usually plotted on a price chart so that it smooths out the noise and it shows a trend. The 200-day moving average might be the most common, but we've been talking a lot about the 50-day this last week because it's been in play in a bunch of big markets. So this week alone, we've seen price break through the 50-day on the S&P 500, the Philly Semiconductor Index for chip stocks, and NVIDIA itself. And also, if you've heard of the Golden Cross or the Death Cross, that just means the 50-day is climbing above or below the 200-day respectively. So suffice to say, there are a lot of uses for it. How do you think about and use the 50-day moving average, Jay?
Well, it's also a good way to not blow up as well. So the best way, of course, is to look at valuation, because then if something's going down, you know whether to buy it or sell it. This is a problem with crypto, is there's no valuation, so you don't know whether to buy or sell it. So it's really gambling. But the 50 days in 200-day moving average is a good way to not enter an asset class at the wrong time. A reporter, we're not big gold traders, but asked me about gold, and I just looked at the chart and said, well, we're 20% above the 50-day moving average. And so a great thing to look on both sides. So, and I said, yeah, it's not bad. Yes, it's not bad to have a little bit of gold in your portfolio, but this was for really retail investors, not investors like yours. And I said, but this is extremely unlikely to be the moment in time to resolve that not having gold. And it turned out
that was
lucky. Yeah, that was the peak. It was like at 4,400 on gold. So just a good way to stay out of trouble, because when you get far away from that 50-day moving average, there's a pretty good chance it could crash down to it. But now, conversely, we're below it. We're above the 100. This could be a good entry point for this market. We're still bullish on the market. We have 7,900 target for next year, as I mentioned. So you shouldn't get out of the market and never get back in. And that's also a reason maybe not to trade too much, because you miss out on huge moves. And they tend to come when you least expect them. So it's not a bad strategy. And we run short. We have a hedge fund, so we do that. But hedge fund managers trade futures overnight and do things like that so they can get back in the market if things change.
So it sounds like you kind of look at the moving averages as a tool to maybe confirm or deny something that maybe in the fundamental work, it's like, okay, this is looking more attractive here. Let's go to the chart. Looks terrible right now. Looks like death, or looks amazing. Actually, maybe we should be overweight this thing that we were kind of nibbling on.
Absolutely. That's the order we would do it. First, look at valuation. Like if you want to pick on Meta, it looks super cheap. Everybody freaked about the capital spending. But right now, it doesn't seem to want to stop going down. So why don't you just wait until the knife falls on the floor and then think about picking it up? So first, fundamentals. Okay, it's cheap. Second, look at a chart and decide where to enter and also where to sell, just like your target on valuation. If your target on valuation's high, you're 20% above the 50-day moving average, you got two signs that you should at least trim. A lot of investors forget you don't have to sell everything. You can sell 10%, you can sell 5%. Just make a sale.
Yeah, you don't have to be a hero.
Right.
No, that doesn't get paid. All right, we need to take a short break. But coming up, we're talking inflation and the Fed, and we'll have a sports-themed runway showdown searching for market income. Stay tuned. All right, this episode is brought to you by the number 2, as in 2%, or the Federal Reserve's inflation target, which it has officially maintained since 2012. Now, Alan Greenspan first made 2% the unofficial target back in the 90s, and the Fed's impetus for an inflation target comes from one of its congressional mandates assigned in 1977, and that is stable prices. So we've got some history here. Now, Jay, I know you have some thoughts on the issue, the value of 2%, how it's played a role in the Fed's thinking over the last couple of years, perhaps for the bad.
Absolutely. So 2% was completely made up by the New Zealand central bank in the 1970s with no empirical evidence to support it. And the Fed raised rates 17 times in a row.
2004?
And from 2004, that takes like a year and a half because there's 8 meetings a year, until 2007, which precipitated the great financial crisis. Now, of course, all the Fed chairs never want to acknowledge this, but every recession in the U.S. has been caused by the Fed tightening. That's why I said earlier that the bubble is going to persist until we have a Fed tightening. So, but they never revised the target, and now there's a huge problem with even calculating it. So first of all, it's way too precise, it's too low, and the index isn't even properly calculated. So we publish separate index. It shows we're below 2. So they should just be more flexible. There's no magic. 3% is not more damaging than 2. It's an enemy of the middle class. It's better to have nominal wages rising and have modest inflation. It's, of course, terrible to have 10% inflation like this Fed created in 21.
And just thinking about the Fed itself, we've seen a lot of shakeups in terms of composition, and there are still some lawsuits in flux here. How do you see this shaking out, and how do you play the Fed versus what it might be next year? What do you think is appropriate for the markets?
Well, one thing to keep in mind is that the 10-year is driven almost exclusively by the what's called the terminal rate of Fed funds.
And let's break that down for the viewers too.
Right. Yeah. So that's where people expect Fed funds to end up.
The very short end of the yield curve
and
with the Fed control.
When we're not in a Fed tightening cycle, that works as well. So if you said, well, what do you think the 10 year's at? And somebody tells you Fed funds just at 100, and that's the 30-year average. So the notion that Fed doesn't control long rates is incorrect because they control short and that drives it long. Well, the reason I'm not too concerned about the Fed most likely not to cut in December is that everybody expects a new Fed chair to come along who's going to be more of a monetarist, which we believe in, less of a Keynesian, less worried about tariffs, less worried about expectations, and cut rates. So it doesn't really matter if they cut it in December or January or March. As long as they do cut it, we get to 3 to 275, 275 to 3. 10-year remains around 4. Mortgage rates stay low, and the housing market recovers. Because we have a recession in the housing market. Nobody talks about it because when you look at the tape, NVIDIA is going by, and there's not that many housing stocks. Right, yeah, not that many housing stocks. But we do, if you look at the investment data, and we have that on our website, we have a recession in construction housing that normally causes a recession, hasn't this time because tech is not just driving software and computers, but also power and data centers. So it's offsetting that. We have slow growth, but not a recession. But the Fed is playing with fire. They do need to cut. Thankfully, we're going to get a new Fed chair, and almost certainly we will cut when we get a new Fed chair.
Yeah, so again, we're recording this November 19th. We have not yet had a new Fed chair nominated. We expect one will be in the coming months. Do you have a preference, a view on who you think among the candidates that we know of, reportedly the finalists for that role, that you think would be best suited to lead the Fed into this next phase?
Absolutely. It's really driven by what I discussed. So Kevin Warsh was on the Fed and raised it 17 times in a row when, by the way, inflation wasn't even significantly above 2%. And then even during the financial crisis was still hawkish. So he's way too hawkish. He's not backing off the 2%. He just wrote a big long op-ed. So we would prefer a pure monetarist, and that's Waller. And he's been in favor of cuts. If you look at all of his calls since he took office, they've been very accurate. Somebody needs to focus on the money supply. You should not increase it 70%. That's what happened during the pandemic. You're going to have inflation. Inflation comes from excessive money supply growth. That's the data, 100% fits that. Keynesians are undeniable about it, that's true. So we need a monetarist because right now we have the money supply shrinking at 6%, normally grows at 5%. So you shouldn't do that either. That's dangerous and needs to be corrected by the next Fed chair.
I want to get back to the markets here. You mentioned a housing crisis, not necessarily a housing crisis, but a housing recession. Mm-hmm. That's fair to say. And there's something that I just learned about, the Hatfield rule. I assume it's named after you. And this is when housing starts fall below a critical threshold. We always have a recession. How is that playing out right now? Is there an exception to that? So what do you see there?
Yes, so that's a great thing about the U.S. It's a free country, so everybody can come up with their own recession rule. There's a Psalm rule as well. But the transmission mechanism of monetary policy, so the Fed has caused every single recession since World War II. And the way they do is they raise rates, and then the housing market crashes, and everybody gets laid off, and then they spend less. So that's happened in 12 out of 13 recessions. It didn't happen in 2000 because that was a tech recession, very extreme tech recession. But we're not having that recession now for two reasons. One, we've never had the boom in housing that we had before. Like even when I was a kid in the 70s, we had a housing boom and we had about 2.4 million starts. Obviously, the population is way, way higher. And we only got to 1.7 after the great financial crisis. So nobody's talked about it, but the economy's become less cyclical. We dropped to about 1.2 million starts, so we're on the cusp of recession. So the economy is weak. That's why employment is weak and why the Fed needs to cut. But this Fed is too focused on their arbitrary 2% target and not adjusting the target for the index.
All right, we got to do a hard pivot here because we've got a markets take on a classic Hollywood gab show staple, Who Wore It Better? And today, we've got a sports theme with a basketball and tennis pro, each on the hunt for income in these markets. On the left catwalk, we have the basketball baller in a sharp team jersey over a blazer, casually dropping easy layups. He represents the classic income portfolio, bonds, dividend stocks, and simple credit that tries to put up reliable points and paychecks on the board. Then on the right, we have the tennis tactician in a crisp whites and warm-up look, tossing controlled first serves inside the lines, She stands in for preferred stocks, real estate income, and covered call strategies that aim for smooth, repeatable checks. So, Jay, who's wearing this market better? The basketball baller with steady layups or the tennis tactician with steady serves?
Well, that's a tough question that I haven't addressed before. But I guess what I would say is we actually recommend, even for older investors who have at least a somewhat substantial investment portfolio, to be well diversified. So have some income. So have some preferred stocks. We actually prefer riskier fixed income. So high yield bonds and preferreds, not necessarily investment grade.
So you're not worried about a credit crunch right now, necessarily?
Absolutely not. You should be, and there was one in the early 22. So when the Fed's tightening, you should absolutely be worried about that, and you should be an investment grade
They're doing the opposite. Yeah.
Right. So now they're loosening. So it's better to be higher up on the risk curve, and even through cycles, you get better returns that are at least competitive with equities. And then we do think you should have large cap dividend stocks and small cap for that matter. But it's fine to have some tech in your portfolio as long as you're not risking everything. So if you have some income, even if it's like half of your expenses if you're older, and then have some tech because it's going to grow probably 15 or 20. And then your overall portfolio can still get a return of 11 or 12. So I would say sort of neither. Just be diversified. Don't be too conservative, but you don't need to. And definitely don't invest in, you can gamble in it, but don't invest in companies that don't produce cash flow or cryptocurrency that doesn't produce cash flow. Better than going to Vegas, but not good for your investment portfolio.
All right. Well, I guess we're going to leave things there. We learned a lot today. At least I did. I really like the fact that you're working on income, and this is a segment of the market that we don't really address a lot. And of course, we got a lot of opinions on the Fed, some history of that 2% inflation target right there, going all the way back to New Zealand in the 1970s. That's my Kiwi shout out for this. And then the moving average, something very simple, and in fact, it's called a simple moving average. Very useful, not only to time the market, but also to kind of gauge risk. And also, I didn't even mention this, you can use it as part of market internals to gauge breadth, how many stocks are above or below it. So I've always been a fan of the moving average. So putting it all together, we got to end it right there. Make sure you check out all the other episodes of our video podcast on the Yahoo Finance site and mobile app. We're also on all your favorite podcast platforms. So be sure to like, leave a comment, and subscribe wherever you get your podcast. We will see you next time on Stocks in Translation.